Basel III is a global regulatory framework that was proposed by the Basel Committee on Bank Supervision. It sets general standards and principles for all financial institutions, mainly banks, in all countries to follow. These standards and guidelines issued by the Basel Committee are strictly guidelines for national authorities, national regulators, to introduce into their own markets. Generally speaking, countries abide by the Basel rule because they're agreed by the Basel Committee, which represents about 24 important countries, plus the involvement of officials as well as regulators, policymakers, and so on. There's a consensus around those Basel principles. Emerging markets generally, and definitely the African countries, the African representatives on the Basel Committee and African countries generally, have noted that some elements of the Basel framework may not apply very well to emerging markets. For example, while emerging market institutions, banks, tend to meet the capital requirements, in fact, they overqualify on that. There are issues with respect to liquidity, which in the mature markets is composed mainly of sovereign bonds of the country in which they operate. Now, in a number of emerging market countries, including South Africa, including a number of countries in Asia, the government doesn't issue many bonds, and because it doesn't run large deficits, and the market is not really deep enough to use government bonds. In some other countries in emerging markets, the sovereign bonds are not highly rated, so they cannot be used as liquid instruments according to the standards of Basel. So there are issues with respect to liquidity. There are important issues with respect to the capital requirements for off-balance sheet activities such as trade finance, which is very important for emerging market institutions. It may not be crucial for large banks in New York or London. Again, because trade finance is self-liquidating, it's short-term, it normally doesn't require much capital. However, the experience of the crisis in the advanced countries showed that off-balance sheet items can generate a lot of risk. So while the requirements in the Basel rule can be understood from the standpoint of mature markets, for emerging markets it doesn't make sense. And similarly for example, financing long-term investments or projects such as infrastructure and financing of SMEs. Again, the emerging markets institutions are keen to continue with these activities, and they see some of the Basel requirements tending to limit the growth of credit in those areas. And of course, those areas are important for emerging markets. The emerging market institutions are voicing their concerns through their regulators, and I think these concerns are being heard by the FSB and the Basel Committee.